Thanks for joining us today on Market Call. I'm Morella Fernandez. Teal Linde with us on the show, manager of Linde Equity Fund. He's going to take your questions on North American stocks. Here's how to reach us. Call us toll free at 1-855-326-6266. You can also email us, marketcall@bnnbloomberg.ca. Teal is joining us remotely. Teal, thanks for joining us. Good to see you. Let's talk a bit about the market enthusiasm. The TSX passed 29,000 on Friday, another record close. What's at the root of this investment boost, do you think?
Well, I mean, the markets are hitting new all-time highs in Canada and the United States. And, I mean, it's just, you can see different areas of intense investor speculation in different areas. And you've seen over the last few months, you've seen the return of meme stocks, and whether it's Open Door Technologies up 240% in 1 month. You've got more leveraged ETFs coming to the market, including leveraged ones with basically single stock ETFs that are tied to sort of very popular AI companies like NVIDIA, Palantir. You've got the reopening of the IPO window, and where you've had a company called Bullish and others sort of lining up to go public, including there's one company called Gemini, which is another crypto exchange, Figure Technologies, a blockchain lender. So some of these are very aggressive companies going public, and it sort of sets the mood for what's going on in the market. You got penny stocks are coming back in vogue. Goldman Sachs recently had a report that said that the shares trading under $1 has hit the highest trading volume as a percentage of total trading volume on record. And if that's not aggressive enough for you, you have what's increasing popularity of zero-day stock options, call options, where people are betting where the market's going to close that day. So if you look at all this, there's a bunch of froth out there. But with the markets hitting all-time highs, I don't think a decline or a sharp correction is imminent, because the overall sentiment is still very neutral. And you might wonder, why is that the case? And that's really because the stock market, particularly in the United States, is becoming politically polarized. And investors, Americans particularly, are looking at their portfolios through either red goggles or blue goggles. Republicans are more optimistic. In fact, the optimism divide today is as wide as it's ever been on record. And for reference, back when George W. Bush was president, the Republicans were the number of Republicans that were optimistic was 13% higher than Democrats, and today it's 47% optimism divide. Yeah.
Okay, so definitely.
So, I mean, stock markets don't peak when there's neutral sentiment, so there's grounds for it to drift higher, particularly with interest rates likely to come down in the United States for the first time in a while.
Yeah, tell me a little bit more about the ETFs you've noticed that are incorporating some of the AI movers into them. How many are out there these days?
Well, there's a lot more that's come out. I mean, I thought there was a report of 127 sort of inverse ETFs that come out. And so it allows people to have, I mean, investing in index funds and ETFs become popular. And so you can buy these ones which are leveraged. So you get even more upside, but you also get the downside as well. And then you have ETFs that are tied to single stocks. And so it's just feeding this risk-on, speculative mania appetite that exists out there. But it's only in pockets. It grabs a lot of headlines. So if you're thinking that the market is frothy, well, there's certain parts of the market are. But again, the overall sentiment is neutral.
Okay, Teal, we're going to take a quick break. We'll line up the first of the phone calls for Teal from Teal Linde Equity Fund. He's taking your questions again today on North American stocks. Here's how to reach us. Back in a moment. Welcome back to Market Call. We are going to start with an email from Barry. He says, I purchased Tourmaline at $76 and I'm thinking about averaging down. Could I please get your opinion? So $76 was a while back. It's now down to $57.69 and sort of really been a little bit all over the place for most of the spring and the summer. First of all, Teal, what do you think is happening with Tourmaline?
Well, Tourmaline's sold off largely because it's, I'm being serious here, it's being punished for thinking long term. The company recently announced that they're going to be elevating their capital expenditures over the next 5 years, which should result in accelerated free cash flow starting in 2030, 31. And a lot of that elevated capital expenditure is going to basically to own their own infrastructure rather than relying on third-party providers. And so it'll give the company more operating leverage. Now, there's a lot of investors that invest in oil and gas stocks that would rather see companies sort of focus on increasing free cash flow to return capital to shareholders, because on average, most companies have not delivered on their returns with their capital expenditures. But Tourmaline is not an average company. With a strong management team, and so I think they're doing the right thing. And if people are unhappy with, if short-term investors aren't happy with that decision, what the company's done, they've created an opportunity for long-term investors to step in at this current price. So for the emailer, is it a good time to average down? I would say that the answer would be yes. Okay, so do you think people are just misunderstanding what they're spending their money in and the return on that? Well, there's always a tug of war in the market between the long-term investors and the short-term investors. And so in the oil patch, first of all, you've got to invest for long-term growth. But in the oil, the E&P companies for many, many years have not delivered. And so Wall Street has said, you just don't invest a lot of money, just maintain your growth, called maintenance-oriented growth. And then just return the capital to shareholders. And so that's an understood sort of new mandate that's been around for 10 years. And I think there were some people that, and Tourmaline's been pretty good at that. They've been able to grow and do special dividends and return capital to shareholders. But there's going to be a little bit less of that because of their decision to increase capital expenditures. So some investors are not happy. However, what's interesting is that because the share price has come down so much, even with the reduced level of capital being returned to shareholders, it's still an attractive stock, even for those who prefer that type of investing. Got it. Okay, let's move to our phone calls. And Chris is on the line with a question. He's in Victoria. Hi, Chris.
Hi, Morella. Great to see you back. Lindsay's doing a great job. All the staff are truly amazing on Market Call. And I'm wondering, Teal, could I please have your thoughts on Lululemon? It hasn't been too kind to me and other investors for a while now, and I'm wondering if you would hold on. I'm at about a 20% loss now. I bought it essentially before the earnings, and it's dropped about 20%. And I'm wondering if you would stick with it or if you'd have a better alternative. Thank you so much. Okay, thank you for the question. We are having a look at Lululemon at 166.26. And it's the forward guidance that we are going to sort of dig into a little bit more. That's been problematic for this company, which has other competitors now in the space, Teal. And really, since the end of January, it has been taking a pretty deep dive. Yes, well, I've been concerned about Lululemon stock for a while. It used to trade at 50 times earnings just 3-4 years ago. And I was warning people that when you buy a stock at 50 times earnings, there's a lot of downside if the growth rates start to slow down. And that's what's happened with Lululemon. Over the last 4 years, revenue growth has slowed down from 30% 4 years ago to 18% to 10% last year, and to 5% expected for this year. And so that sharp deceleration has resulted in the PE ratio of Lululemon falling from 50 to about 12 for this, based on this year's expected fiscal year earnings. And so the question was whether should I hang on or move on to something better. I would say at 12 times earnings, that's you have grounds for hanging on. That is a low multiple in a stock market today where valuations are pretty well rich across the board. So there is a likelihood that as long as they don't have further disappointments and they can just sort of stabilize at this level, a 12 times multiple is pretty low. There's room for reversion back upwards to something at least in the mid-teens. Okay, we hope that helps, Chris. Let's go on to Nazar, who's calling from Scarborough, Ontario. Hi, Nazar.
Hi, Marilla. Hi, Teal. May I have your thoughts on Air Canada, please? Since the last quarterly results, the stock price has been range-bound around $19. With the recent labor unrest still seemingly unresolved, what are the prospects for the next 6 months for the stock price? You have been very positive on the stock in the past. Your thoughts, please. Thank you for taking my call.
Okay, thank you for the question. Air Canada at about 19 and change today. They had the problem with the strike recently, and you're right, it's not resolved. So is this a stock, if you're looking sort of 6 months down the road, if that gets resolved, I guess they could see some bounce back?
Yes, bounce back for sure. You just don't know when, because Air Canada is a fairly volatile stock. They have a history of with their results announcements to either beat by a mile or miss by a mile on a number of quarterly results. And so, I mean, we own Air Canada, and not as a long-term investment, but as a trading opportunity. And if you look at like a 5-year chart, you'll see these. I mean, you'll see it range bound, but within fairly wide oscillations in share price. And so one advantage that we have now today is that since November, Air Canada has bought back 18% of their shares outstanding. And so that's the equivalent of $24 share price being in November being equivalent to $29, or today's share price at 19 being equivalent of $15 prior to the share buyback. So there's a lot less shares outstanding. So from that perspective, Air Canada is actually cheaper than it looks on the chart, on the stock chart. And so our thesis is that this stock ought to get back to $25, which at that point we're probably going to sell out. And again, $25 is sort of like $20 prior to November because of the share buybacks.
Got it. All right, we will leave it there on Air Canada and move on to Walter, who's calling from Kingston, Ontario. Hi, Walter.
Hi, thank you for taking my call. I would like to ask the guest his opinion of TD Bank. It looks like for the past month it's been flat. And would he be a buyer right now, or does he think there's more upside to the TD Bank? Thank you.
Thank you for the question. TD gained back a lot of traction sort of earlier this year, Teal, and it's been hovering between 100 and 102, I guess, is what it looks like. Do you think it still has some room to grow, even though its American assets have been capped?
I think it's probably going to do for a breather. I mean, TD Bank, I believe, is the best performing Canadian bank stock this year. It's up over around 35%, or maybe even a little higher, which is a phenomenal move for a Canadian bank stock. And typically when you have a move that large, it takes a bit of a rest. And so I think many people are surprised how much it's actually recovered and how quickly and how rapidly. And so I would just, if you've owned it for since last year and earlier, I think you're quite pleased how much it's come up. But I think it's due for a breather.
All right, we're going to take a quick break. We're going to be back with more questions for Teal Linde, Linde Equity Fund. He's taking your questions today on North American stocks. Back in a moment. Welcome back to Market Call. Let's go to John on the line from London, Ontario. He's got a question today for Teal. Hi, John.
Thank you, Marilla. Hello, Teal. My question's on Brookfield Corporation, the diversified asset manager. They're profitable. They have double-digit growth on revenue and earnings, and they fit well into the build-out of data centers with their energy, renewable energy, their asset management, and their real estate. I understand it's undervalued. Would you agree? And is it an ad for me, or is it just a hold? Thanks very much.
Thank you for the question, John. It's at $65.99, just short of $66. Do you think it's undervalued, Teal?
I think it's attractive actually right now. I believe it's a stock that everybody should own a piece of in there as a core holding in their portfolio. And so the question was asked whether you should just hold what he has or add. It depends on how much you have. But if you have a little bit, you might want to add a bit more, because this is a company that's got a tremendous track record of growth. They've got an investor day coming up this week. But if we just base on what they said last year in their investor day, they anticipate to grow their distributable earnings by a 17% compound annual rate over the next 5 years. And if you add in their carried interest, they expect that to be 25%. So it'll be interesting to see this week whether they still stand by that 17%, 25% growth outlook. And so, I mean, it's amazing for a company of that size to be talking about those type of growth rates. But and they've been doing that. They've been growing at these type of double-digit rates for 25 years. So you've got to give them a lot of credit, and that's why I think it's a stock that everybody should own a piece of.
And when you talk about it as a core holding, how much would that be?
I think core holdings could be 4 to 5 to 6% of a portfolio. So, if you got a 20 stock portfolio, well, if you have a 30 stock portfolio, a core holding would be about 5%.
All right, good to know. Let's move on to Lewis is on the line from Toronto. Hi, Lewis.
Hey, how are you? Thanks for taking my call. Teal, my question is about Canada's economy. It's been declining. Home prices are down over 23% in the last few years with record inventory. Banking stocks are at all-time high, and Trump is expected to cancel the Kuzma agreement in July. What do you think about shorting CIBC here?
Okay, thank you for the question. We're past July. I'm not sure if he meant next July that he's going to cancel Kuzma. I haven't heard that, but Teal, what do you think of CIBC?
I'm with the caller. I mean, it's amazing. The Canadian bank stocks as a group are trading as a group highest valuation that I can recall in 30 years. And it's interesting because the bank stocks were getting hammered back in the spring when they were worried about all the tariffs. And Canada's actually gotten off pretty easily because of the trade agreement, the U.S.-Mexico-Canada trade agreement. And Canada and Mexico are actually in the best position of countries around the world because of that agreement. But that agreement comes up for renewal next year. And you got to really wonder, is the Trump administration simply going to extend the terms of how they are now, or are they going to take that as an opportunity to really put the screws to Canada? And so for the Canadian bank stocks to be trading at all-time highs, with that threat just a year from now, the question was whether you would short the stock. I don't know if I'd short a Canadian bank stock, but I would certainly look at your weightings and decide, you know what, I think these weightings have gotten to oversized positions, so maybe I should take a little profit or take some of the money off the table.
Okay, trim it if you're in that position to do so. Let's get to an email then, Teal. This is from Rich. He says, hi, I currently have a position in Bank of America, but am considering moving it to either Wells Fargo or JP Morgan for more growth. Thoughts? Is there more growth for either of those two financial companies as opposed to Bank of America?
Well, I guess to the emailer's question about switching over, I think I just stay with Bank of America. I mean, JP Morgan is really reaping the rewards of years of investment that are paying off. I mean, their profitability levels are high, the growth rates are attractive, and this results in the valuation that, again, is the highest that I've recalled it's been at since the late 90s. And I mean, even Jamie Dimon at the end of last year, reporters were asking him, are you buying back company stock? Because they have a company share buyback program. And he said that, well, when JP Morgan stock is low, we increase our buybacks, and when the stock is high, we lower our buy, we buy less. And he said, but right now we're buying nothing. And so that was like last fall, and so the stock price has gone up even higher. So I wouldn't switch from Bank of America to JP Morgan. Wells Fargo, they just got out of the penalty box. As you know, they have TD Bank has an asset cap on their U.S. retail banking business. Wells Fargo has had a cap on their entire bank for the last 7 years, and that just got lifted. And that was sort of anticipated to happen, and sort of reflected in the share price. And then there's Bank of America, which really hasn't had a sort of any kind of big payday or a windfall. In fact, their playbook is to emulate JP Morgan, and analysts figure they're just a few years behind there. So I would stick with Bank of America, given where they are relative to these two stocks, to their two peers.
All right, Teal, we're going to take a quick break. When we come back, we'll have a look at Teal's past picks. That's coming up next. Welcome back. Time to have a look at past picks from Teal from September 9th, 2024, so almost a year ago. At the time, Teal, you picked Alphabet, which was recommended at 148 US, 71, now up to 237.78, so 60% upside in return, total return of 60%. I was just having a look at what happened to this stock after the antitrust case came to a conclusion in the US, and of course it was allowed to keep Chrome, which was a big deal down there, and it's moved up from about 226 to 235.50 today. So, Teal, you got a little bit of a boost just in the last week on this stock.
Yes, the I guess the court case, it turned out to be a best case scenario for Alphabet, a slap on the wrist, really. And I don't think we should be too surprised, because the legal system in the United States is not able to keep up with the fast changes happening in the marketplace, particularly technology. And so when the Justice Department went after Alphabet, they had to use the laws that are in place. And the antitrust laws were created primarily like in 1890. There was the Sherman Antitrust Act, and then in 14. Sorry, I can't remember the act name, but we're talking over 100 years ago. And these antitrust laws were really to go after monopolies that were harming, not amassing power, but harming others, and in two ways: either through predatory pricing, where they're lowering their prices to wipe out competitors, or they're raising their prices to gouge their customers. And with Google, I mean, most of their most popular products are free. They haven't lowered their prices. They haven't raised their prices. I mean, Chrome is free. Google Search is free for users. Gmail is free. You can say the same with Meta. I mean, Instagram and Facebook and WhatsApp, it's all free. And so how could you be doing predatory pricing if your prices have been the same since day one at basically free? And so that was the biggest challenge that they had. They couldn't come up with a case to show that actually harm was being inflicted on competitors or customers.
Okay, let's get to your next pick from last year then, which was Delta Airlines on the New York Stock Exchange. At the time, it was $43.68 US. It's up to $61.29, 40% upside, 42% with total return. What's been happening at Delta that it's made this sort of incredible jump up over the last year?
Simply a reversion back to its average valuation. I mean, before the pandemic, Delta was trading around 9 times earnings for 4 to 5 years, and it's currently trading at 9 times next year's earnings. So when recommending the stock a year ago, I believe it was around 6.5, 7 times earnings, and so it was really recommended on the basis that this is an undervalued stock. And so now it's trading around 9 times next year's earnings, and you could say, well, now maybe it's fully valued, but you're seeing other stocks around the market, like bank stocks, for example, and tech, well, not necessarily tech. They've always been rather expensive, but you're seeing the overall market get more and more expensive. The S&P 500 is trading at 24 times this year's expected earnings. So what you're seeing is sort of segments or sectors that are considered cheap relative to the market are finding money or bids coming their way to lift their share prices up. So the thesis on Delta, which is the industry leader, their valuation, I believe, it should be trading more than 9 times earnings. And so we continue to hang on to our shares.
That's what I was going to ask you. All right, good to know. Let's get to Ensign Energy. On the TSX, this is an oil field services producer at $256 when you recommended it a year ago, down to $211, so an 18% drop here, a total return drop of 18%. Is this a stock you still own? Have you stayed with it?
Yes, we own it. We stayed with it for quite a long time. And the thesis isn't working out, and I will say yet. And I mean, this is a company that 5 years or just before the pandemic, it was the market cap was around $400 million, and it had a lot of debt. And the concern with them at that time by the analysts was that they have too much debt. Well, they've paid down since then half $500 million worth of debt, and the market cap's still at $400 million. So, I mean, there is a saying that the market can remain irrational longer than you can remain solvent. So, I mean, we don't have any solvency issues hanging on to this stock, but it hasn't worked out as planned, but we still continue to own it, and they continue to pay down debt. So at some point, hopefully the market's going to realize how much of a value it is.
Good to know. Teal Linde from Linde Equity Fund. He's taking your questions on North American stocks. We'll line up some more phone calls after this break. Welcome back, and thanks for joining us. Let's go to William on the line from London, Ontario. Hi, William.
Good afternoon. I owned TFII, and I was wondering, how do I go about evaluating if I should buy more?
Good question. Let's go to Teal and ask him just that. Teal?
Okay, thank you for your call. TFII, well, they recently announced results that were better than expected, so people were excited. Well, the corner's been turned, but then they provided guidance where they lowered their outlook. And so it looks like it's I guess the freight market is still in the recovery mode. But with the question, when do I know? How do I know if I should buy more? And we've talked about this in the past with another caller that I thought that it's really hard to know when that inflection point is going to occur or where the bottom's going to be reached. So you have grounds for picking away, starting a position. Now, for the caller, I don't know how much the caller owns, what percentage of the portfolio it is, of his portfolio. So I think, if you got a really tiny position, you could sort of chip away and add some more to your holdings. But if you bought a lot and you're down to a fair weighting, maybe just hang on to what you have.
Okay, let me ask you about TFI, because you mentioned their guidance was maybe lacking, and it's a difficult area right now, transportation. Is most of what's happening in transportation, you think, a result of tariff policy that should unwind in time?
Actually, no, it was mostly because during the pandemic, as you recall, there was all these shortages and actually the whole, I guess, the industrial warehousing and transportation, there was a lot of demand, and I guess competitors invested heavily into buying more trucks and more vehicles, and so there was an oversupply. And that's sort of having to work its way out through the system, is the oversupply that's in the market. And so more of that than tariffs.
All right, good to know.
Although the tariffs obviously aren't going to help. The tariffs situation is not going to help. So it's going to maybe prolong the recovery.
What gets to cross the border, what doesn't. Definitely going to be a slowdown, too. Aaron is online. He's holding in Woodbridge, Ontario. Hi, Aaron.
Hi there. Thank you for taking my call. I heard the previous caller regarding another Canadian retailer, Lululemon. My call is about Aritzia. I see, the explosion of the stock, 5 years, over 360%, over 50% in this year alone. Price per earnings at 41, and I'm thinking, should you be buying in at these highs, at these like rocket levels, or is there, a reason to be adding more to your position if you consider it to be going higher?
Okay, thank you for the question. A tale of two very different retailers. Right now, Lululemon has been sinking. Aritzia has been skyrocketing up, and they're opening more stores, I believe, in the U.S. What is your take on Aritzia? Would you buy in at the point we're at right now?
I wouldn't buy now. For disclosure, we own Aritzia, and it was our largest holding. We've taken a little bit of profit just recently because it's shot up so much, and so I guess the long-term picture outlook for Aritzia is very attractive. If we want to sort of make a comparison to Lululemon, Lululemon has about 750 stores in total. Aritzia has about 137. And so you can see that it still has a long runway for growth. However, the stock has run up sharply, and it's interesting that despite the company talking about how the gross margin could be impacted by tariffs, the stock doesn't seem to be concerned about that. However, I think people should be cautious, should be wary of what the impact of the tariffs could be on a company like Aritzia, where the product they have in their U.S. stores, it basically all comes from overseas. And so this probably wouldn't be the best time to be adding. In fact, I would be looking at your portfolio, and if you bought stock back at in the low 20s and you're at the price today, maybe it's time to take a little money off the table.
It's at 83 plus today. Where would you want to get back in if you were watching that stock?
Well, the stock has a history of being pretty volatile. So if it fell by a third, I think that'd be a good entry point, or if it fell by a quarter. And there's going to be a point where you're going to have Aritzia down by about 25% from its most recent high. That's most likely going to happen. But remember, you got to think the long-term outlook is very, very strong for this company. Lululemon's got stores around the world. Aritzia still has their 137 stores only in Canada and the United States. They ship through e-commerce to 175, 200 countries around the world. But the stores are still only in North America, so they still have room to grow internationally as well to expand their store footprint.
All right. Aaron, I hope that helps you make some decisions as we move on to Debbie calling from Burnaby, BC. Hi, Debbie.
Hi. I'm just calling on C&Q. I have purchased some, but I'm wondering if it's worth to purchase more. I'll hang up and listen to your advice. Thank you so much.
Okay, Debbie calling about Canadian Natural Resources. And Teal, I wouldn't mind getting your perspective on sort of the oil space in general. We had OPEC Plus meet on the weekend, and they're going to sort of put more barrels on the market in what many are saying is already a market that's quite full. What is your take on CNQ's Canadian Natural Resources?
Well, with the threat of OPEC putting on more barrels onto the market, I mean, it's more reason why if you had to buy an oil and gas stock, it should be Canadian Natural Resources, because it's probably the most diversified, or it is the most diversified large cap oil and gas company in Canada. I mean, they've got light oil, they've got heavy oil, they've got natural gas liquids, they've got natural gas, and they've raised their dividend for 25 years in a row. They've got a reserve life index over 30 years. They've got a natural decline rate of about 11%. And so, but because of the diversification of the different commodity or different types of hydrocarbons it has in its portfolio, they can have levers to pull. If natural gas is doing well, they can increase the production of natural gas, and the same with what's going on the oil side. So it's a solid long-term performer, and also I would suggest that it's one of the cheaper stocks in the market today. I think it trades around 12 times earnings. Again, it's hard to find companies trading at low multiples these days, given how much the markets have gone up.
Teal, we are going to leave this block right now. We are going to line up some more questions and phone calls for Teal for when we come back. Here's how to reach us. Back in a moment. Welcome back to Market Call. Let's go to Kevin on the line with this question. He's in Ottawa. Hi, Kevin.
Hi, my question's on Visa. Been a long-time shareholder, but it hasn't performed very well. Hasn't kept up to the market the last few months, and I'd like your opinion on it. Thank you.
Kevin, thank you for the question. Visa, if it hasn't kept up, any reason you see as to why, Teal?
Well, I mean, I think stocks are over a few month period are going to be often outperforming or underperforming the market. But if you look at it from a longer term perspective, Visa, I believe, has done better than the market over the last 10 years. It's been a strong performer, as well as MasterCard. And both companies, I mean, we own MasterCard, but I can speak on behalf of both companies. They are benefiting from the digitization of payments in the international markets. And also the increasing amount of cross-border shopping that's occurring as well. They make a lot of money from that. And so Visa, I believe they're growing the top line around 11%. And for a duopoly, for a very strong company, that's a pretty low-risk return, a low-risk way to get a pretty attractive return. So I think Visa and MasterCard are good long-term holds. So
it's going sideways right now. You just hold on to it until it... something prompts it, I guess, to move up higher. Yeah, I mean, they go in spurts. They'll have a big run for a while, then they may go sideways for a while. So I wouldn't let a 4 month price performance on a company like Visa sort of influence whether you should buy or sell it. All right, we hope that helps. Our last caller. Let's go on to Jacob, who's calling from Toronto with this question. Hi, Jacob. Sorry, Jacob, are you there? Okay, I think we might have lost him. I can't hear him here. His question was about Brookfield Asset Management. We did talk about Brookfield International, I think, earlier. What is your take on Brookfield Asset? Well, Brookfield Asset Management, their 5-year plan is to double their fee-bearing capital to $1.1 trillion. And they plan on doing that. I mean, a big part of that source is just getting more money from their existing clients. I mean, as you know, Brookfield Asset Management is an investor in alternative asset classes. And if you look at the 50 largest institutional investors in alternative investments, 39 of them are clients of Brookfield Asset Management. And yet, Brookfield Asset Management only has about a 2% share of their portfolios. And so obviously there's room to increase that.
And so that's going to be probably one of the big parts of how they're going to grow their AUM. But I would if you're considering Brookfield Asset Management, I would actually rather own Brookfield Corporation. I think you just get a better deal with Brookfield. You get, Brookfield Asset Management is a 75% owned subsidiary of Brookfield Corporation, but Brookfield Corporation owns other assets as well. And I think part of the argument with Brookfield as being an attractive stock is it's trading at a slight discount to the value of all its sort of publicly traded satellite companies and its own private assets. So I would buy Brookfield Corp over Brookfield Asset Management.
Okay, let's go to an email then from Daniel. He says, is Tesla still a good buy? Ooh, so many ways to go for the answer on that question. Tesla right now, I have it at 348 flat and moving around. It never fully recovered after that sort of March and April period. Plus, as I was referring to, there's so much that feeds into the volatility of the stock. Would you invest in Tesla? Do you invest in Tesla, Teal?
No, we don't. We're not a shareholder of Tesla, and whether it's still a good buy, at best I'd call it a precarious one, a precarious buy. I mean, their auto business, the Tesla, the automotive side of the business is not doing well. I mean, their sales are actually falling this year, and they're not making much money. And so, I mean, what's Tesla worth today? The automobile business. I mean, Ford and GM, they're worth about $50 billion each. And so, if you're really generous and say, well, okay, Tesla's worth $200 billion, or let's say $300 billion. I mean, they do have some energy storage businesses and they have some services, but Tesla's market cap today is $1 trillion. And so, how do you justify the $1 trillion with a car company that's not doing very well? They haven't had a new model in 5 years, and the last new model 5 years ago was the Cybertruck, which kind of has been a bit of a flop. And so, where the excitement is for Tesla is basically in the robotaxis and the Optimus humanoids. But I mean, the robotaxi is still very early stage, and there's a lot of competition when it comes to humanoids. I mean, Tesla had the advantage of the first mover advantage with electric vehicles. They had a great brand, and they did very well. But there are countries all over the world that are making humanoids, even in the United States. In fact, in China, just last month, they had the humanoid robot games, like the summer games, where they had teams from about 15, 16 countries, close to 300 different teams competing. Kickboxing, soccer, track, all these robots.
That's terrifying.
It is, exactly, yeah. I mean, unfortunately, no records were made, and they weren't running very quickly, and there was a lot of awkward stumbles. But the team, all the gold medals were won by Chinese teams. So it's not going to be that easy for, I think, even in China, there's so many competing robot humanoid manufacturers all undercutting each other that it's going to be hard to make money when there's so much competition.
All right.
So I think Tesla it's going to be hard to just justify the valuation that they have, let alone increase it.
All right, I do want to get to one last email before we have to take a break. It's from Vince. He says, I've been trying to find a window to start a position for some exposure in the grocery sector. Loblaws looks to be fully priced, but I love its synergies. Do I just plug my nose, buy it after the stock split for a longer-term hold? Loblaws stock split not that long ago. They own Shoppers as well. So there are some synergies with that company. But do you like Loblaws? I know grocers don't make a lot of money. Would you call it a more sort of solid hold, like an offensive hold?
Well, Loblaws is doing great. I mean, considering that the revenue growth is pretty modest, they're always finding ways to get more profit from every dollar sold throughout their entire business. But, and like we've talked about, valuation's been going up. Loblaws is trading at this highest PE valuation in 25 years. And so is now the time to buy? I just think the valuation risks are high when you're buying anything that's at a 25-year high in terms of valuation. Instead, you might want to consider Metro instead. And Metro the valuation isn't as high as Loblaws. And in fact, Metro doesn't get talked about as much as Loblaws, which is the bigger company. It's been the better long-term performer going back many years. I don't know if you're able to put a chart up, but if you put Loblaws' 20-year price chart up and then compare that to Metro, symbol MRU, you'll see that MRUs or Metros has been the better performer, and they haven't had a big run-up like Loblaws had recently. So Metro would probably be one to consider as well or instead.
All right, we could not get the comparison chart up quickly enough. We do have to take a quick break. We have new picks from Teal when we come back. Join us tomorrow on Market Call. John Zechner on the show. He's chairman and founder of J. Zechner Associates. He'll take your questions on North American large caps. Time now for new top picks from Teal Linde. He starts with Blue Owl Capital on the New York Stock Exchange. What do you like about Blue Owl?
Well, I guess, I mean, just on the surface, Blue Owl is a company that's been growing double digits since it's gone public, and top line double digits this year as well, and into the future. And it pays a 5% dividend. So it's a growth stock paying a very rich dividend, which is great because you can count on the 5% dividend. And then if they're able to grow their top line at double digits, well, then hopefully the earnings profit should grow at least 5 to 10% or more. And so you have a double digit return profile. Now, also the company is in three growth areas. They are involved in private, private credit, mostly private lending. They're also involved with taking advantage of sale-leaseback transactions with investment-grade companies that want to monetize their real estate. And they're also involved with very active in bringing alternative investments to the retail investor through the broker-dealer network, both in Canada and the United States. And so private credit is probably their biggest business. And where they see upside there is because right now institutional investors only allocated 4 to 5% of their portfolio to private credit, and there's an expectation that should grow at the expense of private equity. Because private equity is starting to lose some favor because it's very illiquid and the holding periods are very long. And so that's where private credit hopes to make some inroads. There's anticipation that it'll get to 4 to 5% to 10% within 5 years.
I saw the 13 buys from analysts on Blue Owl. How long would you say you've held it?
We've held it for a couple of years.
Okay, let's go to your next topic, which is Amazon, a very well-known company for its retail store, but there are other services I think that you're looking at for future growth for Amazon.
Yes, I mean, obviously, everyone's aware of their e-commerce business, and it's their largest business and it's their most mature. But if the investment thesis for Amazon really sort of focuses on their second and third largest business, and the second one is Amazon Web Services, which is growing faster than their e-commerce business. It's growing, last quarter, it's growing about 17%. And then their third largest business is their advertising business. Now it's also growing even at 23% last quarter. And so what the significance here is that the AWS and their advertising business is much more profitable than their e-commerce business. And so as those divisions continue to grow in size, the earnings and the profits of the company will be able to grow at a faster rate than the top line. So Amazon's only growing about 11% on the top line, but because their second and third and their faster growing divisions are more profitable, it could result in a earnings per share growth in greater than what the revenue growth rate is. So we find that to be quite attractive. They just recently announced just last month that they're going to be delivering fresh perishable groceries to 2,300 towns and cities in the United States by the end of this year for same-day delivery service, and 4,000 in total for one-day delivery service. And so that's pretty significant because in the retail market, about 40% of all retail sales is consumer packaged goods and groceries. And right now, only 15% of that is sold online. So there's lots of room for upside there.
Yeah, new frontier, I guess, for Amazon. Okay, let's get to your last pick, Pinterest, on the New York Stock Exchange, which we don't talk a lot about. They have incorporated advertising into their site. What is it that you like about Pinterest? Is that working for them, the ads that they've now put on the site?
Yes, they're actually working very well. New management came in about 3 years ago, and they've been able to improve the service and incorporating machine learning and AI. They've been able to basically place ads that are actually at a more frequent rate in a way that still allows the customers to still remain engaged. So, I mean, usually when you have a service and you see more ads appearing, people get less engaged. But Pinterest has been able to succeed by actually being able to increase the number of ads they have on there, and while still seeing user engagement increase at the same time. Now, the main thesis for Pinterest is really it's a growth it's a growth at a reasonable price opportunity. I mean, the company's revenues are growing about 15-16%, and the S&P 500, for reference, is only growing 5.5% this year. And earnings are growing even faster than revenues, so 20% plus. And you can get that kind of growth. The valuation you have to pay for Pinterest is just 21 times this year's earnings. So, I mean, whenever you can find an opportunity where you have a company that's growing, that's valued less than the market, but is growing twice as fast as the market, you want to, I mean, if you could find 30 of those and then own them in your portfolio, it'll really make your job easier in growing your account.
Got it. All right, that is Pinterest, top pick from Teal Linde. Teal, that's all the time we have. Thank you for joining us, and thank you for watching Market Call. We'll see you again tomorrow.